Hello Sector Watchers, welcome to the show. This is the 162nd episode of Sector Spotlight for Tuesday the 7th of February. I'm recording it on Monday the 6th. My name is Julius de Kampenaar and I am presenting to you from Amsterdam in the Netherlands. In case you watched the final bar yesterday and got confused about the programming, or maybe you think, hey, that guy is wearing the same shirt 2 days in a row, none of that. I just finished stepping in for Dave Keller, who was on a long weekend with the family, and after doing the final bar live on Monday, which is yesterday when you watch this, I am now recording Sector Spotlight for Tuesday, or today. It's actually already past midnight here in Europe. In this episode I will cover both seasonality and the monthly chart segments, and an interesting alignment of current rotations on the relative rotation graph and the seasonal expectations is on the cards, basically offering a nice potential pair trading opportunity. Ladies and gentlemen, please enjoy Sector Spotlight. For the seasonality segment, we look at the spreadsheet that I maintain, having the percentage outperformance numbers in the upper half, so that's this part right here, and the average performance in the bottom half, that's this part right here. And I've merged these two tabs into one because it allows me to actually have both metrics on the same screen instead of the 3D graphs that we have been using so far. So I'm constantly trying to see if we can improve the visuals for this, and I think I like to stick with this setup for the time being because it gives me the two metrics, and by coloring or shading the values, it allows me to see where the upside and the downside possibilities are. And if you eyeball the line here of February for all the sectors and the S&P 500, you can see that on average the S&P is up 60% of the time in February. So we're off to a good start. But if you look at the relative performance for the individual sectors, you see that most of them are very close to 50. 55, 45, 45, 50. There's 40, 45. But there's two outliers. So there's healthcare, which is at 30. And if you only outperform 30% of the time, that means that you're underperforming 70% of the time. And consumer discretionary is outperforming 65% of the time. So these are the two extremes, and that's where I'd like to concentrate on. If you look at all the others, that's no better than tossing a coin, and that's not going to give us very much. If we look at the percentage, the average percentage gain or loss, there are quite some outliers, which is interesting. So here you have materials, which on general is up 1.1%, but it's only 55% of the time. So what we conclude here is that when materials are outperforming, they're actually doing really well. If you look at communication services, that's in line. That's 50-50, 0.4 is not much. Energy is interesting. So in February, only 45% of the time, the energy sector is outperforming. So 55% is underperforming. But the average outperformance, or the average outperformance is 1.6% over SPY, which is kind of contradictory. And that's an interesting observation. But I'm not going to make a big market call with this type of seasonality. So financials are in line. It's on average losing 70 basis points. It's underperforming 55% of the time, so 45% outperforming. In line, not super strong. Industrials are very close to the S&P 500. So technology, it's on average underperforming in February, but it's picking up a little bit. So those are sort of balancing each other out. Here is staples, that is kind of smack in the middle. That's almost unchanged. And then we have real estate, which is underperforming 60% of the time, and then during those times it's on average losing 70 bips. Utilities, 45% it's underperforming, but when it's underperforming 1.4%, so that could be an interesting angle to take a look at. But as I said, more interesting is healthcare, which is underperforming 70% of the time, and over that time it's losing 50 basis points. And consumer discretionary is on average up 10 basis points, and it's outperforming 65% of the time. So this 10 basis points is not super strong, but I like the 65%, so I'm going to give it the benefit of the doubt, especially when we bring in the relative rotation of those two sectors. Last week we had a brief discussion on the fact that defensive sectors were getting out of favor, they were rotating out of favor. And if you look at how the defense is going into the month of February, then we're actually looking at staples, which on average is underperforming 10 basis points, 50-50. Utilities is in general underperforming 55% of the time, not much, but the underperformance is really bad. So in general, utilities is underperforming SPY 1.4%, so that's very much in line with the rotation out of defense that we highlighted last week. And the same goes for healthcare, which is even stronger. There's a stronger seasonality than utilities, but a little bit less underperformance, but it's still underperforming. So all three defensive sectors are in general underperforming the S&P 500 in the month of February. And staples and utilities are close to 50 or 50, but healthcare is at 30. So that makes it interesting. And on the offset, on the opposite side, we've got consumer discretionary. When we take that information to the relative rotation graph, then we get this. First of all, this is a very interesting RRG. I mean, we haven't talked about the rotations very much this week, but if you look at the overall picture on the weekly RRG here, I think it's quite interesting to see that there is none inside leading and there are none in lagging. So this is all inside the improving quadrant, and they're all moving generally in the right direction, except for utilities. And these are all inside weakening, and they're all at a negative heading. So that's quite interesting. I think that shows us that there is a transition going on. There is a big shift in sector rotation moving on. If we highlight those defensive, so utilities, inside improving but rolling over. Healthcare, inside weakening but heading towards the lagging quadrant. And staples, inside weakening and heading towards the lagging quadrant. I think that move that we detected last week, which said money is rotating out of defense, is still very much going on. And that's a rotation that you expect that belongs to, if you want to say it like that, to a strong underlying stock market. Back to our seasonals. So we're looking at consumer discretionary and healthcare. If I highlight both here, let me actually, you know what I'm going to do? I'm going to put them also consumer discretionary and healthcare. The only two sectors here, I'm going to give them a nice long tail and I'm going to fit it. And what you see here is a clear rotation out of healthcare towards consumer discretionary. The pattern is going on for quite some time already, but it's now really starting to pick up. And now the seasonals are aligning, and that's where I'm coming from. We got the seasonal strength underscoring the rotations that are underway. So that's a trade, that's a pair trade, that's sort of a view, a scenario that I like and which is, I think, very much worth looking into. If we bring in the individual chart of consumer discretionary, then we can see that it's coming out of that downtrend. We already took out that falling resistance, we took out the previous highs, and there is now plenty of upside to this range here, which is around 170. So that's completely in line with the strong seasonal expectation. By the way, it's quite interesting to see that we had that little dip. This was initially a very negative sign because we were breaking a major support level. And what's happening, what you see time and time again, when that break fails and you come back above that previous support level, it's as if a spring is unleashed. It just jumps. It goes directly the other way. You get a very aggressive reaction. And that's happening with consumer discretionary. And it looks as if we have a nice follow through. This is last week. This is the start of this week with plenty of upside, in line with the seasonal expectations. So think ahead like 3-4 bars. That's here. Then we are at the end of February. So that's right here, only 3-4 bars. I think that makes absolute sense. If you look at healthcare, it goes the opposite side. We tested resistance. It failed. And we're now coming back. And we're now in a new support zone where I think the upper boundary was more important than the one that we're now holding up on, barely holding up on. And if you look at relative, we took out the previous low. I dashed this little trend line because it's not really my trend line. It has too few touch points. I prefer trend lines to have multiple touch points. But I just drafted it in, just penciled it in just because. But I'm more watching the break of the previous low and the rollover of the RRG lines, which is putting the healthcare sector inside the weakening quadrant, pointing towards lagging. And especially here, if healthcare is going to drop below 130, if XLV is going to drop below 130 in the coming weeks, then there is plenty of room for an acceleration lower, which is in line with the seasonal expectation. So what we have here is consumer discretionary doing really well, aligning with the seasonal pattern, and we've got healthcare bouncing off resistance, rolling over, weakening relative strength, being in line with seasonal. So for the month of February, I think that the combination consumer discretionary versus healthcare should be on your list. Let's start with the monthly charts for asset classes. I'm going to deal with the S&P 500 in the sector segment because I think that makes more of a combination. So right here, I want to start with government bonds. And what you see here is that the downtrend in bonds is still fully intact. So that's not in line with the improvement that we're seeing in the S&P 500 in the risk assets. This market needs to turn around. For the time being, we're still in a downtrend. And that is a risk that we need to be aware of. If this continues, it'll be very hard for stocks to actually continue their underlying strength that seems to be visible right now. This situation is even better visible in IEF. So GOV is all maturities on the yield curve. IEF covers the 7 to 10 year maturities, and what we see here is that the recent rally is bouncing off a former support area. So this makes very clear that we're not there yet. There's improvement in stocks, but the bond market needs work. And ideally, but this is a monthly chart, so it's going to take time, we would like to see a new higher low to be put into place and then taking out the previous high, wherever that may come, because we don't know whether that 100 is the new high. If we this month continue higher, right now the previous high is around 106, 105.75. So right now, to take out the previous high, IEF needs to rise towards 106. Probably not going to happen this month, but it's possible. So that's still the case here. If you look at corporate bonds, similar, peaked above that former support, now resistance, but not yet convincingly above it. Look at high yield bonds, quite similar. Here is a support area, which was broken, and we haven't even reached that area between 78.50 and just below 80. So here also that trend is still pointing lower. If you look at this trend in isolation, I think you'd say that, hey, this is just broken out. We see a little bit of a pullback, but the odds are for this to continue lower. And especially with respect to the bond market, I think that that's the story that we need to keep in the back of our minds. If we move on to commodities, then they are deteriorating. For a long time, I was working on the scenario that we had this very nice run up. We ran into resistance. We were holding around support here in the 32 area, but we didn't really put in a new low. As a matter of fact, that trend line is now broken, and if you would put this on a little bit shorter term time frame, there's a nice support area just above 32, which is broken. More important level obviously is around 30. That goes back to 2009 and was tested here in 2015 and once again here in 2021. So I'm still looking for that to hold, but the nice improvement, the nice uptrend that we had for the last 2 years, that is off the cards right now. This one needs more work. If commodities were to move into a new rising trend, we need more work. That's going to take time. So commodities are sort of parked away right now. It's not massively risky. I don't think it's going to go crashing down, but the upside right now, especially for DJP, is quite limited, I would say. GSG is showing quite a similar, not surprisingly, quite a similar pattern. A little bit more downside risk, I think, here. This can go to around 18 and we're currently around 20, but we're breaking this rising trend line. We're taking out these lows here. All in all, commodities are deteriorating, and how far they will deteriorate, we only can wait and see. And then we have currencies. So here's the dollar index, and I think that's at a crucial level. Look at where we put in the low. So this is kind of peeking ahead, but this is only a couple of days trading. This is the month of February, and this is where January closed just above this basically final support area. Former resistance, now support around 100. If you look at the euro dollar chart, it looks much worse. It doesn't look as nice as this. So this is against a basket of currencies. This is US dollar deterioration, US dollar weakness. And if we hold here, and you can see that today we're already way off that low. We're now at 102.75. So Thursday, Friday, and now Monday. Those 3 days are really putting in a nice work for the US dollar. But we need to hold here. In order to keep up that dollar strength, long-term dollar strength picture, we should not drop below, let's say, 100. Keep that in mind. Cryptocurrency, here's Bitcoin. Flip back above resistance. And short term, I think 25K is where resistance is. If you look at shorter term charts, that's what you will see. In the end, this move could go to around 28, maybe 30K. That's where things are becoming really, really interesting for Bitcoin. So the longer term, we're kind of sideways. Just got back into the range. On the way to 28, short-term resistance around 25. And then the stock-bond relationship, we're still in that trading range, but we're pushing against overhead resistance. And that underscores the, as I said, and which I will show when we talk about sectors, under the hood strength for stocks, for sectors, and the still weak charts of the bond market that we just showed, which makes sense to actually watch 4.3. If you look SPY IEF above 4.3, I think that'll be a nice handle to start moving more towards bond and more towards stocks and out of bonds. For the monthly sector charts, we're already a few trading days into the new month, so please be aware of the fact that I'm ignoring the last bar on the chart. So all the levels, all my analysis, all my takeaways are quite rigidly done using only the last bar and then wrapping all of that up in my spreadsheet as we're used to. So I'm going to go quickly over all these sectors and then wrap it up in the spreadsheet and look at the S&P 500. So here is communication services. As you can see, we have now broken out here, but the trend, if you just look at even now, is still down. So we have lower highs and lower lows. So this trend is still down. We have a nice low into place here around 155, and we're now working our way higher. That's one. If we go to consumer discretionary, you can see that we dipped below the previous low, we moved above it. That is a good sign, but the rhythm of lower highs and lower lows is still in place. So we gotta give this still a downtrend on a monthly chart. So I know that we've been talking about consumer discretionary being strong and aligned with seasonality. Please be aware, this is a long-term time frame. These are monthly charts. In this chart, consumer discretionary has all the room to move higher towards 1380, almost 1400. That's way up, but very strictly taken, that trend is still down. You can see that all the lows are still lower, all the highs are still lower, and all the lows are still lower. Until that changes, until we get a higher low and a higher high, this will remain a downtrend or a sideways trend. Here is consumer staples. That is stuck in that trading range where it is for months already, so that didn't change. If you look at energy, that is still an uptrend. You can look at just even again put a higher high, a higher low into place. This is a new higher low, and we're looking to get above that previous high. As a matter of fact, energy is the sector that's closest to move to new all-time highs, to take out the really long-term highs. If you look at financials, that is sideways. Why is it sideways? Here is a lower low, and we just took out the previous high. So we have a higher high, wherever it's going to be. We know that it's going to be higher than the previous one. So a higher high is in the making, but we're still dealing with a lower low. So that's sideways. That's not a downtrend, it's not an uptrend. It's definitely improving. I mean, this is not a bad sign. When you take out that in-between high, that could become very nicely a double bottom. So that's all good, but it hasn't emerged in a new uptrend yet. Again, just like discretionary, financials here, when we hold above 595, they can go all the way up to the area around 675, maybe even the high here, which is 693. So don't confuse when I label maybe a downtrend or sideways as something that's not going to go up, because that's definitely not the case. So here's healthcare, a trading range, very clearly labeled sideways, moving between the upper and lower boundary of that range that's in place for quite some time already. And as we saw on the shorter term chart and following the seasonality, there is plenty of room for healthcare to move all the way down to the bottom of that range and that former rising resistance line, which can be expected to form support right now. Look at industrials. Here also we have a lower low and a higher high, sideways. The rhythm is not there yet. Upside potential could easily go to 900 without a problem. Support around 825. Look at technology. Strictly spoken, this is still a downtrend. We have lower highs and lower lows. Is it improving? Definitely. It can go to 2600, but it needs to take out that previous high there. So stay tuned for technology. If you look at materials, that is again a lower low and a higher high. So it's sideways. And you see that now more and more sectors are going into a sideways trend. Sideways means transition from one trend to another. And more sectors are now going into a sideways pattern. So in a way, that is a return to strength, an improvement. Real estate, definitely still in a downtrend, but the move is going to go higher. So Next resistance, 285. Eyeballing it, I think it might be too much in the near term, but this could be a high. It's going to be in the plane making, but there's plenty of room to put in a new lower high. So you got to wait and see how that happens. Again, this is all monthly charts. This is long-term stuff, people. Go to utilities. It's the last sector. Again, we have sideways. You see that it's dipping below and it's rising higher. So we are in a sideways move. Look at this. It looks muddy. It's just a pool of mud is going on, and this is transition type work. With the S&P improving, utilities are underperforming, and you can see why. And that brings me to the S&P 500. Here you can see that, again, technically, we don't have a new higher low in place, but we're sort of taking out levels, so it is definitely improving. I think that we had this 4100 area, which is still in play. We're at 4111 when we closed yesterday, but the upside is towards 4300. Under the hood, there's definitely improvement visible here for the S&P 500 as well. When we wrap all that up in our spreadsheet, then we can see that it was quite a good month for the S&P 500, so up 6.2%, with only staples, healthcare and utilities, the defensive sectors, going down in price. Here is the matrix with the trends, and it didn't change compared to last month, so we have one uptrend left, that's energy, and services, discretionary, technology, real estate, and the S&P 500 are still in downtrends, but as I mentioned, we can clearly see a shift in sector rotation underway, and that reflects in some of the risk-reward ratios, if you want, that we can see here. So in communication services, there is quite some upside with limited downside. Same for discretionary. Here, energy, obviously, because it was such a strong sector running into resistance, is the other way around. Technology is kind of in the middle, 10 up, 10 down. But overall, I think that the underlying strength is becoming more and more visible. We do need more proof, and I hope that the bond market will actually come to the rescue and confirm what we think we're seeing in the stock market overall. And we're done. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on Stock Charts Television. In case you missed it, please catch the replays on YouTube or any of the on-demand channels. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.